GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you, and also good to be with our listeners.
And happy Chinese New Year's to everyone. Gung Hoi Fat Choi. Bob, interest rates, what's happening with them? Can central banks really manipulate them the way they want?
Well, they have done, and the biggest financial bubble in history, it has taken place in the bonds until last year. And the bond market, I want to point out, is way bigger. The global bond market is way bigger in market cap than the global stock market. It's huge. So anyways, last year the long-dated treasuries, bond future, took off and had a terrific rally, and right up and into early July. Now, on the way there, it registered our upside exhaustions, which is momentum, and it registered a sequential sell, which is a pattern determinant. And at the time, we looked at all this stuff and said, hey, and particularly with the decline in European yields, like the German 10-year note down to effectively zero, and then other shorter instruments down to minus rate. Well, I mean, this has never happened before, and it was one of the signs of incredible speculation in the bond market, particularly by central banks. So what we thought at the time was that the European Central Bank really is so big, and their credit markets are so small, the corporate market is so small that they are quite dominant. But we looked at the U.S. market and argued that less so there. There's a lot of different players in the U.S. market, and which would overwhelm whatever manipulations the Fed or the Treasury were attempting. So the conclusion was that it was ending action, and that it could be the end of the great bull market for bonds that started in 1981. And this is interesting for me personally, because that's the year I started taking the research to financial institutions, and the presentation included a slide that said that no matter how much the Fed printed, that financial assets would outperform commodities like hard assets. And that was really quite unacceptable at the time, because everybody was geared for inflation, and of course it was the end of inflation, the beginning of the world of financial asset inflation. So we caught both ends of it, and by ending action we meant that it could be the end of the big bull market for bonds. And the bond did reverse, and it's come down. And then you had, later on, you've had the different bond instruments, different categories of bonds making the same technical highs in a sequence. So here, I just got to list them. Yeah. So the investment grade bonds then peaked in August and rolled over. Then you have the other ETF, the emerging bond, EMB. It soared up to an overbought in September, and it rolled over. I think the high was 116, and it sold off to 107. So then 2 weeks ago, we were looking at another high yield ETF, one done by Vanguard, and it had more, or it had less of the bad stuff in it, more of the good stuff. So it rolled over. It did, the speculative high rolled over in 2 weeks ago. And then that leaving only one left, which was the junk side, the lowest grade stuff. And the symbol JNK this week has given the upside exhaustion signal plus the sequential sell signal. So beginning in July, you've had these technical objectives met, and they have been the ones that say, hey, this is rolling over and heading down. So the last sector has been the junk bonds, and they have given the signal that has been reliable for since we've been using them. So it's highly likely that the lower grade bonds would sell off in price and yields go up. This is not good. One of the things that helped keep the lower grade corporate bond sector together, of course, was the election in the U.S. with a pro-business government and cutting of taxes and the promises of cutting of regulation, which is very good for corporations. But obviously this came into the market and it's there. So, yeah, the decline in junk bond prices and the accompanying rise in yields would not be good. So, because what you have here is in this huge bubble, there's been more debt issued than ever before. I mean, it's been huge. And any of these, you've had bond bubbles in history back in earlier, times, and it leaves behind a tremendous wreckage, because what happens, there's such an enthusiasm to buy bonds, and then you have countries or companies that otherwise, with shaky credit, may not be able to sell bonds, but whoa, they can do it in a mania. So you end up with a huge amount of debt, and nobody stops to think about how it's going to be serviced. It's just, let's just get the paper out. So here comes the problem, is how is it going to be serviced? And even in a flat-lining economy, historically, in a mania, the amount of debt issues is more than even a normal economy can service. You've got interest payments to make, you've got redemptions to meet, just the usual servicing the obligation. So then what happens? Then that really turns the economy down, because everybody suddenly starts avoiding debt, trying to get rid of it, trying to write it off, get a thing. So we're probably heading into what one could call a bond revulsion, where all bond classifications get marked down in price and liquidity just sort of disappears. So the last player in the game, junk, has finally accomplished the sequential sell. So that side is going to be interesting. Also, there has been, the mania, as mentioned, really drove interest rates in Europe down to next to zero, and in some cases shorter instruments were trading at negative, which has never happened before. But if you take a look at a couple of the nervous credits there, Italy, which everybody's talking about, a huge banking problem. But this week, the Italian 10-year note did reach a new high yield for the move. So that's really quite the reversal from last summer. And then you also, the other one that's been a bit of a weak sister has been Portugal, and it too has clocked new high yields for the move on their 10-year note. So interest rates in Europe have been heading up since July. They more or less kind of turned through the summer. So we're very aware of this, because it's very important, because one of the things that has been very much on has been the huge expansion of governments who have become particularly ambitious, and the political movement beginning with Brexit in June, whereby Britain elected to leave the euro, and then the next step in this political phenomenon was the election whereby the popular uprising won the election and beat the Democrats. So this fits into a bigger picture because the huge bond bubble has been to fund the big expansion of government. And let's just shift back to the U.S. on this one. And it's been an experiment in unlimited government, which has corrupted the Federal Reserve System, the central bank, whereby the Fed has been suborned to funding, providing unlimited funding to an experiment in effectively unlimited government. And so it's had the appearance, particularly last summer, of being a perpetual motion funding machine. And those who are ambitious in government assume that the money's always going to be there because, hey, we can float bonds and we can print the whole thing. But this is beginning to reverse. So it's very important that the financial markets begin to reject the concept of the perpetual funding machine, which is just early days on this one. And then you've also had the political change whereby in England and in the U.S., these two dramatic steps are whereby the public is beginning to take control of government from ambitious experts. It is, in my thoughts, well, the last political popular uprising was in 1989 when the folks in Eastern Europe took on a murderous police state and shut down communism and tore down the Berlin Wall. Very exciting stuff. So although the people that have been in the United States that have been supportive of big government, Democrats and whatnot, they're highly upset about the change. And for some reason or other, they're calling people who support Trump Nazis or whatnot. They're saying, and yet Trump and the people who support him, and basically Trump represents the popular uprising, and the popular uprising is for less government. So it's no way, it's the opposite of Nazis, which were National Socialists, and it's opposite of Communists, which are International Socialists. So very exciting. Actually, Jim, as this progresses, it could be the equivalent of a great reformation. The last one was the early 1600s. And through the 1600s, when society got fed up with intrusive government and took major steps to get away from intrusive government. In England, the big one was the Glorious Revolution of 1688, which was essentially run by businessmen out of London and smallholders and landholders and all kinds of people throughout the country against an absolutist king. And it was called the Glorious Revolution because the ordinary people won on that one. And this is what the parallel is now, so it's big stakes. And the important part has been the ability of the big, deep, as they call it, the deep state, to fund itself. And it's funded itself through bonds and through inflation, and that seems to be ending. Very exciting times, Jim.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, what's going to happen with the U.S. dollar, the Canadian dollar?
Yeah, the Canadian dollar will suffer because whatever move we've had now in commodities, you've had the industrial commodities such as base metals and crude oil improve a whole lot from the disaster of last January, February. So that's been a positive for the Canadian dollar. And these industrial commodities could peak out or roll over, say, in the next 2 or 3 months, in which case they head down. and the the Canadian dollar would weaken relative to the U.S. You also have the federal government and most of the provincial governments going in the wrong way. They're still in the big government mode, and as yet there is no major popular uprising in Canada to oppose that. But I think it can happen. And in the U.S., the change will continue. People are really upset, many are upset in Canada that with the free trade agreement coming into question, that Canada may suffer on that. But I think Canada's got more concerns about the government and the people having far too much debt in a potential next phase of a contraction coming in. I think that's more important. And as far as the trade goes, north and south, it's not been as injurious to the Americans as has been the Mexican. But the main problem, as I've said before, is that it's probably a half-decent agreement between Canada and the U.S., maybe too much bureaucratic stuff in it. The view I've had is that if Canada really wants free trade, declare free trade unilaterally, everything, just make it all up. And but then with NAFTA, they allowed the central banks the privilege to continue to depreciate currency. So you have an agreement on trade, and then Canada with a 25% decline in the dollar, it's a cheat. It is a dirty cheat. And so ideally, free trade between Canada and the U.S. and a currency board to peg the Canadian dollar at par with the U.S. It would be disturbing, upsetting, and whatnot getting there. But the end result would be the most practical thing you could have with, our long border and our long, the two countries share a common world of middle-class prosperity. And so I think that goal can be aimed at and over time accomplished. So I think the more immediate concerns would be the spreading credit contraction and the next recession whenever that comes in. So, and then we also look at gold, and silver's getting close to a buy on its latest decline. But to go back to the U.S. dollar here, we've had a correction from when it got up to over 103 on the DX and it's probably it's had a very good correction, more than I thought it would do, and it can stabilize in here and then make the next move up. The Canadian dollar would go down, but this would be in commodities rolling over like crude oil and base metals and that sort of thing, which is probable within the next few months, whereby whatever firming there is going on in industrial commodities now could be finished by around March. So, and crude oil is actually looking a little nervous. And also, as we noted at the first of the year, the oil patch stocks, XLE got up there and had a very high, pretty good high RSI, good momentum on the way up. And it gave some sequential sell signals, so the oil stocks have been heading down, which may be discounting that the whatever firming in crude oil is on recently may not last too long. So let's put it this way, we're not terribly bullish on industrial commodities. The grains, KX, they're up at the high end of the trading range, which has been our target, and after a little while here, they may be able to extend the rise at least for a few months. So not great excitement in commodities. And now also, if you're having the next step up in the U.S. dollar, it's not going to be helpful to the metal gold or the metal silver, but what you have here is that after a correction in the gold shares a little longer, we think there's probably another buying opportunity coming up on them. So long as the price of gold gets back on being stronger than many commodity prices, like we're looking for the real price of gold to do the next leg up, which is probable, but it did move up from a couple of months ago. Well, actually, no, from last year, and then it's had a little pause in here, a bit of a correction. So the next leg up in gold's real price will be very important.
Bob, thank you so much for chatting with us.
Yeah, Jim, as I said, good to be with you, and we look forward to talking again next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Questions for Bob or the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening. And Happy Chinese New Year.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.